Hello, everyone. This is Justin Kraus, the Washington Retirement Planning Specialist. Thank you for taking the time this evening to be with us. Today's topic will be emotion and your money. One of the growing areas in our industry is behavioral economics, where 2 Nobel Prizes have been given in economics on this subject. The reason this is very important is because human beings tend to make decisions emotionally, and oftentimes they make the wrong decisions. And this will be the area of our focus today. We are delighted to have with us Heather Hughes. Heather is an industry leader in the financial services field. She has distinguished herself as a highly regarded industry resource. She is an institutional sales executive with the Sun America Mutual Funds. As Vice President of Sun America Funds, Hughes brings over 8 years of experience in the financial services industry and is ranked number 1 in production. She is responsible for all mutual fund sales in Washington, D.C. metro area, exceeding over $700 million. Ms. Hughes has established and maintains close working relationships with the top financial advisors in the industry. Aside from her sales responsibilities, Heather provides investment options, analysis, and performance information regarding mutual funds. She makes her home in McLean, Virginia. Hughes graduated from Baruch College in New York, where she studied finance and investments and holds an MBA from American University in Washington, D.C. Heather has also been featured in the Washington Post, the Baltimore Sun, CNBC, the Libertarian Republican, the Economic Policy Journal, MoneyNews.com, the Fox Business Channel, NBC News, and also Yahoo Finance. So without further ado, please let me welcome and introduce Ms. Heather Hughes.
Thank you so much, Justin, and thank you all for allowing me to be here with you and run through this with you. I work closely with the Washington Retirement Planning Specialist, and I'm happy to answer any questions you may have after the short presentation. So here, we'll start with emotions and your money. 3 key areas that we're going to outline here. Understanding your emotions, that's first and foremost. Number 2 is emotions and investing, 5 potentially costly mistakes and how to avoid them. And number 3 is managing our emotions, the keys to staying calm in a turbulent market. So we'll kick it off with the first, understanding emotions. Many psychologists believe that people are hardwired to make irrational emotional decisions. It's known as a psychological bias, a tendency for the human brain to respond emotionally and make errors in judgment when faced with uncertainty. One of the most common biases is loss aversion. It's a psychological trait that makes our losses seem twice as painful as the pleasure of your gains. So let's put these biases to the test. Which investment of the following would you choose in these scenarios? Number 1, investment A. If you have $1,000 to invest, would you select to offer a sure gain of $500, or investment B, which offers a 50% chance of either gaining $1,000 or gaining nothing? Be honest. Scenario 2, if you had $2,000 to invest, would you select investment A, which offers a sure loss of $500, or investment B, which offers a 50% chance of either losing $1,000 or losing nothing?
There's more money in both loss cases.
Heather, I don't want to interrupt there. I just wanted to let everybody know that it is possible to mute your phones. If you'd like to mute the phones, we will unmute them at the end as well. I just wanted to put that out there for questions. Thank you. Sorry, Heather.
No problem. So these are, again, the 2 scenarios, investment A and investment B in both scenarios. And let's look at what the common response is on the next slide. So investment A for the first scenario, of course, offer a sure gain of $500. You'd rather lock in a sure gain usually than a 50 chance of receiving more. That tends to be the most common answer. But surprisingly enough, on the second scenario, because of these psychological biases that we're discussing, investment B is more often chosen, which is somewhat the more risky choice. Instead of offering a sure loss of $500, we're saying, okay, we'd rather take a 50% chance of either losing $1,000 or nothing, when it's actually, again, the riskier choice than just saying, I'll accept my $500 loss. But that's because of these psychological biases. It may not be the best decision in the long run. So why do people make this choice? Again, because of loss aversion. That loss aversion trait causes us to take on more risk to avoid a sure loss. I'm sure we're all guilty of it at some point in time. I am as well. Psychological biases combined with these emotions of investing can lead to costly mistakes. And basically this just takes you through the bull and bear market cycles and how you may feel at different points of time, overconfidence and bull market reaching, all-time highs, maybe 2006, 2007, or right before the tech bubble, and then you have the bottom despair there, which is usually could be the greatest opportunity for potential gain, actually. So the more emotional the event is, the less sensible we all are. And the second point on the agenda, emotions and your money. Number one, impatience, investment trap, the emotions in investing. So impatience, investment trap, right? Trading more frequently to try and quickly enhance returns. Most of us don't have that type of trading mentality anymore. I know 20, 30 years ago that was very common. Now it's more of a longer-term investment horizon versus intraday day trading. And I know CNBC, which I'm a part of, is guilty of sometimes promoting that, but that may, again, not be the best solution. Unintended consequences, potential for higher trading costs if you're trading a lot, and more taxes, and of course lower returns. So how do we avoid this? You build and follow an investment plan, of course, that can help you stay invested over the course of time and limit some of your emotions there. Many investors don't have the patience to stay invested. How long do you think most equity fund investors have remained in their investment over the last 20 years? This is really interesting because you might think it's a lot longer than the average, and I hope you're beyond the average. The answer is only 3.33 years. That's it. So when we think of what does long-term mean, for most, the patience has lasted only 3.33 years, 3 1/3. Not that much, not that long. Moving in and out of the market can lead to lower returns, actually. So investor behavior over the past 30 years, for example, if you look at the gap between performance of somebody who's moving in and out of the market versus just buying and holding, say, the S&P, the average equity fund investor and an active fund is actually still up 3.69%, but underperforming the S&P, which is up 11.11%. So, of course, that just shows the gap there. So following a plan can help control your emotions. Again, stay focused on your strategy, not emotions. Don't get distracted by the short-term movement of the market, and remain on track with your long-term goals. Number 2 is overconfidence. And the investment trap here is relying on these hot investments to help boost your portfolio's performance. The next big stock tip that Jim Cramer gives you, for example. And the unintended consequence of such is lower performance and increased risk of loss. Not always, but sometimes. And how to avoid this trap. We diversify and select investments based on research, not emotions or hot tips. And the Washington Retirement Planning Specialist can definitely help you do that. Momentum can turn at any time. I really like this chart. Follow the crowd, and you may end up buying at the top of the market right before a significant decline. I'm not saying the market's going to decline tomorrow because we're nearing all-time highs, but a good statistic to look at is this net investment, the second middle column there, which is showing in 2001, $504 billion, which is rather high for that time if you look at the years right before and right after. That was an all-time high investment flow into the market. So many people are chasing after the market. They want this kind of return, and you see what happened in 2002. The market was down 22%. Same thing happened in 2007. We saw a record inflow into the market of $879 billion in inflows, and look what happened in 2008. Market's down 37%. So you can kind of track the flow of money, and following the herd mentality may not always be the best strategy either, because we see two outlined scenarios where we had extremely high money flows into the markets, and the following year markets were down.
And everyone, I just want to send one more reminder. If you are able to mute your phones, just mute those, and then at the end we can unmute those and open it for question and answer. Thank you, Sarah.
Thanks, Justin. We are about halfway through. What a difference a year makes. Last year's winner may be this year's loser. What we mean by that is if you look at the best performing asset classes in 2007, for example, it was international stocks. And in 2008, international stocks were the worst performing asset class, down 43%. Same thing happened in 2012 with emerging markets, outperforming up as much as 18%, whereas in 2013, 2 years ago or less, they were down 2%. Last year, they even underperformed. So that's that herd mentality again, and not having a diversified portfolio. Just because something outperforms one year, it may not be the hottest stock or sector the following year. I really like this chart. The yellow boxes indicate they're indicative of a diversified portfolio. The other colors, if you're a visual person instead of a quant person, it's just showing, for example, at the top, the boxes over 1998 to 2002, orange and purple. We're seeing large cap growth in bonds. They're outperforming. That's saying they're the best asset class. Well, okay, for a few years. But you'll also see orange and purple boxes at the bottom of your screen there as well, showing that bonds and large cap growth stocks, just because they're the best performing one year, they may lag the following year. So maintaining that diversified portfolio kind of keeps you nice and steady right in the middle, so you're not having these big volatile swings where you're the best performing asset class one year, and then the next year you underperform severely, and you've had a significant loss. Fear. I like the big bear on the left. He looks pretty scary. So the investment trap here is waiting too long to get back into the equity market. I know since 2009, some of you may have thrown in the towel. And you just said, you know what, this is it, and I don't want to get back into the markets. And now here we are, the market's doubled, and 5 years later, you might still be thinking about getting back into the equity market. And who knows if it's too late or if it's right or wrong for you to be invested in the markets, and that's what the Washington Retirement Planning Specialist can help you with. But the unintended consequence here is, of course, the inability to capitalize fully on the potential market rebound, which we have had. So how do we avoid this? You consider easing back into equities, what we call dollar cost average strategy, which is sort of automatic smaller payments over time versus one huge lump sum. And that can kind of help ease some of your fear from the big bear on the left-hand side there. So fear may result in lost income. As we know, the market has rebounded significantly. But what's interesting is that the first year of a bull market, nearly half of the returns of the bull market's total gain, it may last 5 years, may last 10 years, but over time, historically, nearly half of those returns come from the first year. 41% is the median first-year return, and the median total return of a bull market is 85%. So if you are trying to time the market or you're on the sidelines because of fear, missing that first year can cost you nearly 50%. So let's take the guesswork out of timing the market. Again, dollar cost averaging allows you to increase your exposure to the growth potential of equities. How do we do this? You see the two boxes here on the left side. You can invest a lump sum, of course. Let's say $40, $10 a share, and you've bought 4 units. But if you dollar cost average into your investments or your mutual funds, over time, for example, over 4 different periods, instead of one lump sum, you do $10 at a time. The price of each unit, because you're buying at a lower price at times, not just all at the same price at $10, you dollar cost average, it reduces your price per unit down to $7.87 in this case. So you've bought more than 4 units. You end up buying 5.08 units in this example. So dollar cost averaging is just a really good way to again, it's all about emotions. It's going to ease your fear, and not just that, but it could equal greater potential for future growth. You could also dollar cost average into the market and you end up buying at higher prices. Yes, that is the risk you take, but that's not such a bad thing because you've protected yourself on the downside where you may end up with a lower cost basis as we did here. Number 4, panic. Investment traps, selling equities in down markets and moving to cash for short-term safety. The unintended consequence is a potential shortfall in your retirement income. How do we avoid this? Stay calm and use history as a guide to maintain your long-term focus. So the cost of selling stocks can be astronomically high. I mean, this is impressive. I mean, over 30 years, 1984 to 2013, if you've held cash, you've been on the sidelines, we all know that probably hasn't done that well. Looks like with inflation adjusted here, $360,672. This is a hypothetical growth of $100,000. So bonds are going to equate over 30 years, or did, between 84 and 2013 to $936,107. Stocks, though, $2,346,227. And that's the growth of $100,000, hypothetical growth over that time. The average stock market return in an equity fund or in an S&P, just using the market as a benchmark. I mean, that is an astronomical difference. So it really can pay to stay invested in the market. The price of missing the best days in the equity markets, for example, this chart showing 93 through 2013, which is 20 years, it can be very costly. If you are just on the sidelines for 10 days, 20 days, or 40 days out of those 20-year period, some of those days, if it's marked one of the best days, the higher returning days in the market, even though it isn't that significant of a time frame, you can really hurt yourself here. You see if over the whole time frame, 9.2%. If you miss the market's 40 best days on the right-hand side there, you're seeing you're at a loss of 1% over 20 years. It's really important to stay invested in the market. So history has been on our side. We hope. So since 1926, this is a chart showing all of the long-term growth in the stock market through wars, recessions, natural disasters, financial crises. that we've had over time, and the stock market has continued to chug along. So yes, although there are ups and downs, you protect yourself when you can, where you can, because you hope you don't want to retire in one of these years when we do have wars. But if you can wait a little longer and have a long-term approach to investing and take your emotions out of the equation, look, since 1926 to 2013, through all of these wars and depressions, the market's still higher by exponential amount. Number 5, indecision, investor behavior. Staying in cash to help protect your assets from market volatility. You may be feeling that way right now. So the unintended consequence is, of course, losing purchasing power over time, especially if we see inflation. We aren't right now. We're in a deflationary environment in the U.S., but that could easily change. How do we avoid this trap? You review your asset allocation mix. And if you have some cash, you can rebalance or using, as we discussed, dollar cost average. So don't let indecision reduce your returns. Cash alone is unlikely to generate the returns necessary to achieve your goals. This is just showing the returns since 1926 through 2013. We're looking at stocks versus bonds and cash. And blue is before tax and inflation, and the orange bars are after tax and inflation, of course. And you can see that stocks and even bonds clearly outperform cash. Cash is negative after taxes and inflation. So use the following three buckets model to determine the right asset allocation mix for you. Number 1, you have your short-term investment bucket, less than a year. You have CDs, again, cash, as we mentioned. You're going to get an average annual return of about 3.5%. Number 2, if your investment time horizon is intermediate, we call that 2 to 5 years. So you're going to look at things like bonds if you're nearing retirement. And that average annual return is about 5.5%, again, since 1926. And number 3, if your investment is a long-term horizon, we call that 6+ years. That includes assets like stocks, of course, and the average annual return there is 10.1%. And so the last but not least on the agenda, managing emotions. The keys to staying calm in a turbulent market. The keys to staying calm in a turbulent market. Knowledge, so you want to understand how your investments will react to different market conditions. Strategy, build a broadly diversified portfolio that can help you generate more consistent returns. Remember those boxes in the color chart we had with the diversified portfolio, the orange boxes running in the middle there. And perspective is work with, of course, a trusted financial advisor who has the expertise, experience, and third-party objectivity to guide you through difficult times. Understanding your investments. So we're going to focus on 3 key areas here, volatility and income. Key benefits and potential pitfalls. Remember, the more volatile your investment, the greater the range of emotions you may feel. So the more likely it may be that you'll make a costly emotional mistake. This is just showing a chart of stocks and the volatility of stocks from 2003 to 2013 over 10 years. Of course, you would be a lot more emotional when you see a chart like this. It looks like an EKG versus some of the other asset classes. So your emotions may, and income may go up or down with the market, of course. The next chart is bonds, which would show we'll get back one. The next chart is bonds, and it just shows, clearly a lot less volatility there, but there's some still exist. So your emotions and income may not fluctuate as much. And then, of course, the next slide is cash. And you see a straight line. Obviously, treasury bills and other cash investments can help you stay calm but offer little income and no potential for market growth. Although I must say that treasuries were the best performing asset class last year, which is rare. But remember, again, those boxes, just because something is the best performing asset class one year, that may not be the case. It may fall to the worst performing asset class to become that the following year. Build a broadly diversified portfolio of traditional and alternative assets. You see on the left-hand box, we're listing the traditional asset classes. And now over the past, I would say 5 years, not even 10 years, in the industry, we're using what's called alternative assets. And these are a list of some of the alternative assets, which are a lot more complicated investments, but can help you control your emotions and maybe earn more higher and consistent returns. So last but not least, this is 6 ways to manage your emotions while diversifying your portfolio. All of these are more complex investments, and I think that when you sit down with your reviews with the Washington Retirement Planning Specialist, you can take a look at some of these investment options if you think you have an interest in them and they could work for you. I really, really appreciate being a part of this evening with you, and thank you so much for joining us, and thank you, Justin, for hosting it. And I'm happy to, if you have any quick comments, it doesn't even have to be on the presentation, but maybe about CNBC or anything you may have, any question you may have, feel free. I believe on the right-hand side you can just type it in chat. You don't have to speak the question either, but I'm happy to answer it now or at any other point in time. If you get a hold of Justin or his team at any of your reviews, I'm happy to also later on follow up with you.
And Heather, thank you so much. And I know I speak for the attendees as well that was very interesting and knowledgeable as well. So thank you. And as Ms. Hughes said, we will now open the floor for questions. Feel free to type the responses on the web browser, and also feel free to unmute your phones at this time and answer any questions from there. Thank you.
Thanks, Justin. This is Patrick calling. I have a question for Heather in terms of the few slides at the beginning where she said the understanding emotions, the chart where she had the options to pick A and B on both sides, and I was just looking at that second option where it said offers a 50% chance of either losing $1,000 or losing nothing. And my question is, my thought was, why couldn't we just have nothing and say I do nothing? And then how would you classify me if that would be my choice, as opposed to picking either one of those choices?
Good question. Thanks. So you're saying you're saying you would choose that option of losing 50% of losing $1,000 or nothing, or you would not?
I would not. I would choose nothing. I wouldn't do either one of those, A or B.
Oh, well, that would be good too. If we had A, B, C choice, of course, that would be the smartest answer. You're right. It was just they wanted to ask, the survey wanted to ask a hypothetical question where if you only had 2 answers and 0, losing nothing was not an available choice, which that would be great. Of course, you're right. You would choose that if it was. But they're saying most would choose the 50% option to lose $1,000 or lose nothing, and the studies were just showing that that's because investors want to avoid risk at all costs. But it's actually less risky to just accept that $500 loss. But who wants to do that either? Yeah, I understand what you're saying. You're saying I just choose to lose nothing, but no, unfortunately, they didn't allow that as an answer there. But that would have been the right thing to do, to choose for sure.
Okay. Thank you.
And Heather, I do see a question as well from, I guess, Mr. Alex Villano. He was asking for you, Heather, 20 to 30 years of investment time after, there can be 20 to 30 years of investment time after retirement. Is stock market the best place for my investments?
20 to 30 years after retirement. Again, I think that, well, what's best, even though you said that it is after retirement, what's best for you may not be the right answer for someone else. So I think when you sit down with Justin and GB's team, unfortunately, I would deviate to wait for your review with him because it's a very specific issue addressed to your personal situation, and I think that the Washington Retirement Planning Specialist would be best suited to give you a black and white yes or no answer on that. But the stock market, as we know through the presentation, is a lot more volatile. And again, this piece on emotions and your money, 20 to 30 years after retirement, you probably don't want to have these ups and downs of emotions, and you want to sleep at night and not worry about what's going on in Greece or the Federal Reserve. So I'm not going to say hold all cash and go hide out in a cave somewhere with your gold and your guns and do nothing. But I would say it would be a question to discuss during your review. But there's certainly a much more volatile asset class as we've seen, and that may not be appropriate for someone 20 to 30 years, 100% investment after retirement, unless you're okay with taking a lot of risk. So that'll be, your personal decision. I'm sure they'll be happy to sit down with you and address that. And if so, then over time you've seen the returns from stocks have far outweighed those of bonds and cash, especially inflation adjusted. I hope that helps.
I think that was very helpful, Heather. Thank you very much. And with that, we have another question as well here, Heather, from Mr. Plater. What were the worst performing asset classes in 2014?
In 2014, well, I know the best were treasuries and utilities. The worst were small cap. I would, off the top of my head, and I'd want to get clarity, but the Russell 2000, which is an index you might hear about on the financial news, it's basically a small cap index. So the Russell 2000, which is small cap index, and the international markets, which is tracked by what we call the MSCI. You may see it in some of your reviews if you have any benchmarks like the Dow Jones or the S&P. So both the small cap and the international markets were the two worst performing asset classes, I would say, in 2014. And not a lot of people saw that coming. A lot were overweight. You always want different exposure and to be diversified. But a lot of people were overweight small cap and international markets because they're considered undervalued. The U.S. markets were nearing all-time highs, where you hear about, we're at all-time highs in the stock market and the Dow Jones or the S&P, but you haven't heard that about the international markets. So both the international markets and the small cap index were the two worst performing markets last year. We'll see if that happens this year. Again, you go back to that colorful chart and those different boxes on the screen, and what's number one year sometimes falls to the bottom, and the one on the bottom rises to the top. So that could be the case with international markets and or a small cap sector this year.
Thank you again, Heather. So with that, we'll leave a moment for any other questions here. Okay, well, thank you everyone very much again for your participation. Thank you for attending this evening. And also, we of course would like to thank Ms. Heather Hughes for our night. Thank you, Heather.
Well, thank you so much. I will be on CNBC tomorrow at 3 also. So I'll maybe discuss some more about emotions.
And Heather, I hate to come back one more time, but we do have one more question here, if we can fit in one more. So
sure.
Patrick lets us know. He says, if I'm 2 years away from retirement, what are your recommendations for my 401k?
I wish I could. Oh my gosh, I can't. Because again, it would be so specific. Well, go ahead. You were going to give some details right here.
Agreed. And Patrick continues there by saying he has 50% invested in small caps, 50% invested in common stocks as of today. And really, I think he's just looking for an idea from your standpoint. Should I get more conservative? 50% small cap, 50% common.
2 years away from retirement. I mean, again, I'm not an advisor. That's what I work with, some of the best advisors in the country. I'm lucky enough to work with the Washington Retirement Planning Specialist team. They're a huge producer for Sun America. They're one of the largest teams in their whole independent advisory group in the country, of course. So they would be best suited for it. But, I mean, if you're a risk taker and you're 2 years away and you don't mind having small caps, which are extremely volatile and did not do well last year, and if that's part of the plan, part of your investment strategy, then it shows based, again, on the presentation to stick to your strategy. But I just can't imagine that I wouldn't be able personally to sleep at night if I was overweight. But if you don't mind taking a little risk, then I'm sure that's something you can discuss with the team at your review, and maybe that could be a fit for you. But it does sound somewhat more risky than the average. And again, what is average? But than the average person who's 2 years away from retirement to take on as much risk as 50 small cap and 50 stock. But hey, that may work out, and then maybe you can take us all to dinner. So I hope it works out well for you. I'm sure they will discuss it in your review and make sure that that's the best approach.
Heather, I agree, and thank you very much for that. We did get a comment as well for what's the topic you'll be speaking on tomorrow with MSNBC?
They never give them ahead of time. My guess is the Federal Reserve, because Janet Yellen was on the Hill today, and I believe there's some big hearings on net neutrality, which I am not an expert in at all, but they tend to just go with whatever's happening in the news, breaking news at that time. So most likely the Federal Reserve, and we'll probably touch on oil a little bit as well.
Thank you again, Heather. And we'll leave a moment here, a few seconds for any other remaining questions.
I wish I could give specific advice. I'm sorry that I'm unable to, and your team is much better suited for that, given your experience.
Yeah, absolutely. And like you mentioned as well, it really is on an individual per need basis. And, that's how we approach and look at every situation. So with that, I will thank everybody once again. And if there's no more questions at this time, I would like to thank you again for your participation. Thank you for attending. And again, Heather, thank you for all the insight. I'm sure we all look forward to seeing you again on MSNBC. And thank you again for your time.
Thank you. Good night.
No problem. Good night, everyone.